All right, so welcome back to the deep dive, where today we're going to be diving headfirst
Headfirst.
into the world of online used car sales.
All right, sounds good.
And, buckle up, folks, because this one is a wild ride.
It really is.
So our main source today is this investigative report by Hindenburg Research.
Oh, yeah.
You know these guys, right?
Oh, yeah.
They're known for their deep dives into companies.
Yeah, absolutely.
And
Yeah.
this report, it does not disappoint.
No, it does not.
They spent 4 months
4 months.
interviewing 49 people,
Wow.
reviewing tons and tons and tons of documents.
A lot of paper.
And
Yeah.
they're basically saying that, on the surface,
Right.
Carvana seems like this real innovator, right? They've
Yeah.
got this slick online platform.
Sure.
They promise this hassle-free buying experience.
Yeah, the vending machines and all that.
And their stock, man.
It's been up and down.
It's been a roller coaster, 99% drop in 2022, followed by a 284% surge this year.
I mean, who can even keep track of that?
We're at Hindenburg.
Yeah.
They're alleging some serious financial shenanigans here
Oh, yeah, big time.
that could leave shareholders, hanging out to dry
Yeah, that's the implication.
with nothing.
Potentially, yeah.
And they're basically pointing the finger
Uh-oh.
at the CEO's father,
Okay.
who is this billionaire
A billionaire.
with a past conviction for bank fraud
You don't hear that every day.
as a key player in this scheme.
Right. So we got to talk about that.
Yeah, I mean,
Yeah.
questionable accounting practices,
Oh, yeah.
risky subprime loans,
Lots of risk.
and a whole lot of money
Oh,
flowing between Carvana and a private company owned by the CEO's dad.
that doesn't sound good.
So, yeah,
All right, lay it on me.
let's get into it, all right?
Right now.
So, Carvana, they're often seen as this disruptor in the used car market, right?
Oh, yeah, for sure.
They operate entirely online. They have this massive inventory,
Right.
and they focus a lot on customer experience, right?
Absolutely. That's their thing.
Like no haggling,
Nope.
pushy salespeople.
Get rid of them.
You just click, click, click buy.
And your car just
It's like magic.
magically appears
Woof.
in your driveway.
At least that's what they tell you.
That's the pitch.
Yeah.
And that model, it really attracted investors initially.
It's a good story, right?
Totally.
Yeah.
And for a while,
It's working.
it seemed like they were on top of the world.
Absolutely.
But then their stock took this massive nosedive in 2022.
Right. We talked about that.
99%, remember.
Ooh.
And investors were getting spooked by rising interest rates,
Yeah.
slowing car sales,
Uh-huh.
and Carvana's mounting debt.
Those are all problems.
So it really looked like the
Oh.
party was over.
like the music stopped.
Yeah.
But then,
But then,
here we are in 2024,
what a difference a couple years makes.
and their stock is somehow surging again.
The back, baby.
And investors seem to be buying back into the story, thinking the company has turned things
We
around.
love a comeback.
But Hindenburg,
Yeah.
they're pointing out that
Reality check.
we have to remember that the auto industry is notoriously cyclical, right?
Absolutely. It's always up and down.
Yeah, and used car prices have actually dropped
Right.
more than 20% in the past few years. And subprime auto loan delinquencies
Okay.
are even higher now than they were during the 2008 financial crisis.
In 2008. Wow.
So that context is important, right?
Huge context.
When you're evaluating a company like Carvana,
Yeah, absolutely.
we
Because
gotta look at the bigger picture.
it's easy to get caught up in the hype
Oh yeah, the hype machine is real.
of a stock surge.
Yeah.
But you have to ask yourself, is this recent success sustainable?
Good question.
Or is there something riskier going on? Something lurking beneath the surface?
Right, and that leads us to Ernest Garcia II.
Okay, the father.
Yeah, the CEO's father.
Right.
Now, remember, this is a guy who has a history with the law.
We got to talk about that.
He's a convicted felon who served time for bank fraud.
Yeah, you mentioned that.
And that history is something that you can't just ignore
Not at all.
when you look at what he's been doing with his Carvana stock.
So what's he been up to?
Because right before that stock crash in 2022,
Okay.
Garcia II
Yeah.
sold
About
a massive $3.6 billion
billion. Wow.
worth of his shares.
That's a lot of shares.
And then during this recent rally, guess what?
Let me guess.
He sold another $1.4 billion.
He just keeps selling.
Yeah.
Yeah.
Interesting.
So the timing of those sales is just, well,
It's suspicious.
suspicious.
Yeah.
Right.
Right.
So is this just a savvy investor timing the market perfectly?
That's what he wants you to think.
Or is it something more? Could be.
I mean, it's certainly a question that the regulators will be asking.
Yeah, they're going to want to know.
Now, let's talk about how Carvana actually finances all those car sales. All right.
Okay, the money part.
So they rely heavily
Heavily.
on third-party financing
Okay.
to buy the auto loans that they originate from customers.
So they're not using their own money?
Right, and it's a key part of their business model.
It is, yeah.
But it can get a little shaky,
How so?
especially when you start looking at who they're relying on for those loans.
Who are they getting the money from?
So for a long time,
Yeah.
Ally Financial is their
Okay.
main partner.
B Bank.
But then subprime auto loan defaults started
Oh,
creeping up,
nobody likes defaults.
and Ally got nervous,
Makes sense.
and they amended their agreement with Carvana
They changed it
5 times
5 times.
in just 2 years.
That's another good sign.
And they started quietly pulling back.
Backing away slowly.
Yeah, buying fewer and fewer of their loans.
Interesting. So they were seeing something.
So that brings up the question, if Ally was pulling back,
Yeah. If they're not buying the loans,
who is stepping in?
yeah, who's left?
Well, that's where things get even more curious.
Oh, I love curious.
A mysterious new buyer emerged,
A mystery buyer.
and Carvana insists
Well, he
that
insists.
they are unrelated.
Unrelated, huh?
But of course,
They came later,
Hindenburg
but
did some digging.
They always do.
And what they found is that this unrelated buyer is likely a trust affiliated with Cerberus Capital Management.
Cerberus.
And guess who's the chairman of global investments at Cerberus?
I don't know who.
None other than Dan Quayle,
Dan Quayle.
who also happens to be a Carvana director.
Wait, Dan Quayle, the former vice president?
The one and only.
That's a twist.
Okay, so
Carvana is saying this new loan buyer is unrelated,
unrelated.
but their own director
Yeah,
has close ties to the firm.
it's a little too close for comfort.
I mean, come on.
That's hard to believe.
It really is.
It definitely makes you question the whole arm's length transaction thing that they claim.
Big questions.
And it raises another question. What's the quality of the loans they're selling?
Right, because if Ally's not buying them,
Exactly.
someone else must think they're good.
Especially since Carvana seems to be targeting a very specific type of borrower.
Who's that?
So let's talk about that.
Okay, let's talk borrowers.
So Carvana's loan portfolio
Right.
is heavily weighted
Oh, what's it-
towards subprime borrowers.
Subprime. Okay.
People with low credit scores
Right.
who might have trouble getting a loan from a traditional bank.
Not the most credit-worthy folks.
And remember what we said earlier about subprime auto loan defaults?
Yeah, they're on the rise.
They're already on the rise.
Not good.
So Carvana is essentially doubling down
Doubling down.
on risk by focusing on these borrowers
That's a risky bet.
and their underwriting standards.
Let me guess.
Well, let's just say they're not exactly strict.
Loosey-goosey?
A former Carvana director actually told Hindenburg,
He told them.
we actually approved 100% of the applicants.
100%.
100%.
That's not underwriting, that's just giving out loans.
So it's not exactly a sustainable business model in the long run?
No, not at all.
Right. It makes
Yeah.
you wonder if they were just trying to boost their loan volume
Got to keep those numbers up
at any cost.
at any cost.
And it's worth noting that Carvana has issued
They've issued
over $15.4 billion
$1 billion with a B.
in asset-backed securities.
Okay, so what are those?
Now, for those who aren't familiar,
Yeah, break it down.
asset-backed securities are basically bundles of loans,
Okay.
in this case subprime auto loans,
So they're packaging them up
that are sold off to investors.
and selling them off.
But the problem is,
Yeah.
if those loans go bad,
Uh-oh, here's the risk.
those securities could become worthless,
Yikes, that's not good.
and the delinquency rates
So how are the loans doing?
on some of those securities issued by Carvana,
Yeah, give me the numbers.
well, let's just say they're not pretty.
I bet they're not.
60-day delinquencies
60-day.
among their supposedly prime borrowers
Even the prime ones.
are more than 4 times the industry average.
4 times. That's a lot.
So you start to see a pattern here, right?
I'm starting to see it.
Risky lending practices,
Yeah.
questionable loan buyers,
Yeah.
and a whole lot of potential trouble brewing under the surface.
That's not a good recipe.
Yeah.
Yeah.
It's making my heart skip a beat, too.
Not a bad.
And it gets worse.
Oh, no, worse.
Because now we're going to dive into the grift territory.
Grift. Okay.
This is where the relationship between Carvana and Drive Time,
Drive time.
the private dealership owned by the CEO's father,
Right. The dad.
becomes even more important.
Right. So how are they connected?
So remember, Carvana offers
Wow.
extended warranties on its cars.
Most dealerships do.
And guess who administers those warranties?
Who? Don't tell me.
Drive Time.
The dad's company.
Yeah.
Wow. What a coincidence.
And according to Hindenburg,
What do they say?
this relationship is being used to manipulate Carvana's financials.
Oh, so that's how the grift works.
So they're alleging
They're alleging.
that Carvana is shifting costs to Drive Time
Okay.
and pulling profits forward from those warranties,
So they're moving money around.
all to artificially inflate
Inflate what?
their revenue and profitability.
To make the numbers look better.
Right.
Yeah. Classic move.
And these aren't just small transactions we're talking about.
So how much money are we talking?
In 2023 alone,
Just last year.
Carvana generated $145 million
Million.
in other revenue from related parties,
That's a lot of other revenue.
which is about 8.4%
Almost 10%.
of their total gross profit.
That's significant.
So it's a significant amount of money.
Yeah, no kidding.
And it's hard to ignore the potential for conflicts of interest when you have this much money flowing between a public company and a private company owned by the CEO's father.
It's a bit too cozy, isn't it?
Right.
Yeah.
And it gets even shadier.
Shadier. How is that possible?
Carvana is also using Drive Time
Uh-oh. What are they using them for now?
to avoid marking down inventory.
Right.
Instead of taking a loss on cars that aren't selling,
Right.
they just offload them to Drive Time
They just get rid of them.
at inflated prices.
So they're hiding the losses.
It's like they're trying to hide their losses by shuffling cars and money back and forth between the two companies.
It's a shell game.
A former Carvana director even compared it to Fight Club,
Fight Club.
saying, "There are certain things we don't talk about, and we don't talk about Drive Time."
That's not reassuring.
I mean, that's not exactly a reassuring statement, is it?
No, not at all.
It makes you wonder what else they're not talking about.
Exactly. What else is going on?
And when you add in all the other accounting tricks Hindenburg uncovered,
Oh, there are more.
it starts to paint a very troubling picture.
This is getting messy.
So
All right, hit me with those accounting tricks.
let's talk about those other accounting tricks.
Lay on me.
For example,
Yeah.
remember how Carvana claims they don't hold loans for extended periods?
They said that.
Well, their loans held on the books
Right.
have actually increased 50% since 2021.
50%.
And they're not recording any loss reserves on those loans.
So they're pretending everything's fine.
So they're making their financials look rosier than they actually are.
It's all smoke and mirrors.
And there's evidence that they might be delaying loan sales
Why would they do that?
to manipulate quarterly earnings.
To smooth things out.
It's a classic accounting trick, sometimes called cookie jar accounting,
I've heard of that one.
and it's all about creating the illusion
Yeah.
of smooth, consistent earnings,
Right.
even if the underlying reality is much more volatile.
Much more up than down.
Then there's the whole issue of Carvana's retail gross profit per unit metric,
Okay, what is that?
which investors use to gauge the profitability of their vehicle sales.
So it's a key metric.
Well, Hindenburg found that Carvana is inflating this metric
They're inflating it.
by dumping selling costs
Okay.
into other expense categories.
So they're moving costs around.
Basically, they're making their retail business look more profitable than it actually is.
It's all about appearances.
They're also cutting corners on car reconditioning
Reconditioning?
while claiming that their quality standards remain high.
So the cars might not be as good as they say.
A former reconditioning leader told Hindenburg
What did he say?
that Carvana created an economy line of cars.
Economy line.
Okay.
With lower standards.
So they're cutting corners.
But they're not being transparent about it with investors.
That's not good.
So all of this points to
Points to
a culture of opacity.
not being transparent and a willingness to bend the rules to make the numbers look good.
They're playing a dangerous game.
And we haven't even talked about their auditor yet.
Oh, the auditor, right.
So Carvana is being audited by Grant Thornton,
Grant Thornton. Okay.
a mid-tier accounting firm
Right.
that also has a relationship with Drive Time.
Wait, they audit both companies?
And Grant Thornton's former UK CEO has publicly stated
He said.
that they're not in the business of looking for fraud.
Not looking for fraud. That's their job.
So you have to wonder how thoroughly they're scrutinizing
Scrutinizing.
Carvana's financials.
It doesn't sound like they're looking very hard.
To make matters even worse,
It gets worse.
Carvana is currently subject
It's a subject.
to an undisclosed SEC investigation.
The SEC is involved, huh?
That's right.
When did this happen?
The news came out back in August.
A couple months ago.
And the company has been pretty silent about it ever since.
That's never a good sign.
It definitely adds to the sense that there's a lot more going on here than meets the eye.
There's definitely something fishy going on.
I have to say, this is one deep dive
Yeah.
that's leaving me feeling a little uneasy.
It's a lot to take in, I know.
But before we get too overwhelmed,
Yeah, take a breath.
let's take a pause here
Okay, good idea.
and come back in part 2,
Part 2, all right.
where we'll continue exploring this report and its implications.
Sounds good. I'm ready for more.
We'll try to make sense of it all
Let's make some sense of this chaos.
and figure out what it means for investors
We're investors, right?
and for the future of Carvana.
Can Carvana survive this? We'll find out.
Welcome back to our deep dive into Carvana.
Oh man, where do we even begin?
I know, right? It's like we opened up this Pandora's box.
And a whole lot of ugly stuff came tumbling out.
Exactly. You have this company that's trying to present itself as this tech innovator, changing the way we buy used cars.
Yeah, disruptor, game changer, all that jazz.
But then you start looking closer and it's like a different story altogether.
It's almost like a bait and switch, you know?
Totally. They're luring in investors with this flashy image, but behind the scenes, there's this whole web of shady dealings and potential financial trickery.
And the more you dig, the worse it gets.
And don't even get me started on the timing of those stock sales by the CEO's father,
Oh yeah, that's a big one.
right before the stock tanked in 2022.
It's like he knew something we didn't.
I mean, maybe it's just a coincidence, but it sure does raise some eyebrows.
Eyebrows, red flags, alarm bells, the whole 9 yards.
But let's not forget about the real victims here.
Who are you talking about?
The everyday investors who bought into Carvana's hype without realizing the risks?
Right, the people who put their hard-earned money on the line.
And what about the customers who might end up with a car that's not what they expected?
Because they cut corners on reconditioning.
Exactly. It's like they're sacrificing quality and transparency for the sake of profits.
And hoping nobody noticed.
It's a tough lesson to learn, but we can't just blindly trust companies no matter how big or successful they seem.
It's all about doing your research, digging into the details.
Looking beyond the surface, asking tough questions.
Especially when billions of dollars are involved.
And those insider stock sales, those should always be a giant red flag.
Absolutely. It's like they're saying, get out while you still can.
It's a classic signal that something might be wrong.
And in Carvana's case, those signals were blaring like a siren.
It's like they were laying out a trail of breadcrumbs leading right to the truth.
But most people were too distracted by the shiny car vending machines to notice.
So where does Carvana go from here? What does the future hold?
Well, according to Hindenburg, it's not looking good.
They're basically predicting a financial meltdown.
And they're saying that the Garcias, the CEO, and his father might walk away with billions.
Leaving everyone else to deal with the fallout.
It's a pretty bleak outlook.
It is. Carvana is facing so many challenges. A slowing used car market, rising defaults, scrutiny from regulators, and now this damning report.
It's like a perfect storm brewing.
And they've built this whole empire on a foundation of risky loans and questionable accounting practices.
It's a house of cards waiting to collapse.
Right now, the market might be buying into the turnaround story.
But eventually, reality has to set in.
The music will stop, and someone's going to be left without a chair.
And it's likely to be the investors who didn't do their homework.
So the takeaway here is clear. Don't be fooled by the hype.
Don't get blinded by the shiny objects.
Do your research, ask the tough questions, and be wary of companies that seem to be playing fast and loose with the rules.
Because when it comes to investing, knowledge is your best defense.
It's about protecting your hard-earned money.
And not falling prey to those who might be trying to take advantage.
So let's take a breather here, and we'll come back for part 3.
Where we'll wrap things up and talk about what investors can learn from this whole Carvana saga.
And we're back for the final stretch of our deep dive into Carvana.
Where we've been trying to unravel this tangled web of corporate intrigue and financial maneuvering.
It's been a wild ride, hasn't it? Filled with twists and turns and enough red flags to make even the most seasoned investor a little nervous.
And if there's one thing we've learned, it's that you can't judge a company by its website or its stock price.
You have to look under the hood, kick the tires, and make sure you're not getting sold a lemon.
Especially in today's market where there's so much noise and hype surrounding certain companies, it's easy to get caught up in the excitement and overlook the potential risks.
We've seen time and again that even companies with seemingly innovative business models and impressive growth trajectories can be hiding some pretty dark secrets.
And those secrets can have devastating consequences for unsuspecting investors.
That's why it's so crucial to approach every investment with a healthy dose of skepticism and a commitment to doing your own research.
Don't just take someone's word for it, no matter how convincing they might sound.
Go beyond the headlines, dig into the SEC filings, read analyst reports, and pay attention to any red flags that pop up.
And speaking of red flags, let's recap some of the big ones we've seen in the Carvana case,
Well, excessive related party transactions, for one.
where a company is doing a lot of business with entities that are closely tied to its management team.
That can create opportunities for self-dealing and conflicts of interest,
Then there's the issue of aggressive accounting practices.
which can be used to make a company's financial performance look better than it actually is.
And of course, we can't forget about insider selling.
When company executives or board members start dumping their shares, it's often a sign that they know something the market doesn't.
And in Carvana's case, we saw a lot of insider selling right before the stock took a nosedive.
So what can our listeners learn from this whole saga? What steps can they take to protect themselves from similar situations in the future?
Well, first and foremost, I would say never invest in anything you don't understand.
If you can't explain a company's business model to a 5-year-old, you probably shouldn't be investing in it.
Exactly. Take the time to learn about the company, its industry, its management team, and its financial health.
And don't be afraid to walk away if something doesn't feel right or if you have unanswered questions.
Remember, there's no such thing as a sure thing in the stock market.
Every investment carries some level of risk.
And it's up to each individual investor to assess that risk and make informed decisions.
Don't get swept up in the hype or let FOMO, fear of missing out, cloud your judgment.
The key is to be a discerning investor, to do your homework, and to be comfortable with the risks you're taking.
So, as we wrap up this deep dive into Carvana, let's leave our listeners with one final thought.
The market is full of opportunities, but it's also full of pitfalls.
By staying informed, asking tough questions, and being mindful of potential red flags, you can navigate those pitfalls and increase your chances of success.
Remember, knowledge is power, especially when it comes to investing.
So stay curious, stay skeptical, and keep learning.
And until next time, happy investing.
Thanks for joining us on the Deep Dive.